The US stock market and a casino are shockingly similar, except at a casino, the house advantage is printed on the wall, the drinks are free, and nobody's pretending it's a retirement plan. But on Wall Street, they put it in your 401k, slap a long-term investment sticker on it, and tell you to check back in 30 years. And the dirty secret that nobody in a suit wants you to know? The entire system was never designed for retail investors like you. It was designed by institutions, for institutions. And retail investors, that's you and me, we're not the players at this table. We're the chips. Now, before you close this video and go back to your index funds, hear me out, because this isn't a stock market is a scam, buy gold video. This is a here's exactly how the game is rigged so you can stop playing it wrong video. Because the stock market is the best wealth building tool in human history. The S&P 500 has returned an average of 10% annually for the last 100 years. 10% every year, on average. If you put $10,000 in an S&P 500 index fund at age 25 and never touched it, by age 65, you'd have $452,000 from a single $10,000 investment. That's not magic, that's compound interest doing its thing. So the market works. The problem isn't the market. The problem is how most people are participating in it. And to understand why, we need to look at who actually controls this market, because it's not who you think. The stock market has three types of players. First, institutional investors. These are the hedge funds, pension funds, and asset managers. BlackRock alone manages $10 trillion. $10 trillion! That's more than the entire GDP of Japan. They have algorithms, analysts, and information you will never have access to. Second, market makers. These are the firms that literally set the prices. They sit in the middle of every trade and skim a tiny cut every single time. Citadel Securities alone handles about 25% of all U.S. equity trading. 25%. Third, retail investors. That's you, that's me. We show up with our Robinhood app, our Reddit threads, and our extremely confident opinions about which EV company is going to win. We are, statistically speaking, the least informed people at this table, and somehow we're surprised when we lose to the other two. Now I know what you're thinking, I'll just pick better stocks. And I love the confidence, I really do. But let's look at the actual data. Over any given 15-year period, approximately 92% of actively managed funds run by professionals with billions of dollars, PhDs, and entire research teams failed to beat the simple S&P 500 index fund. 92%! These are the smartest people in finance with the best tools money can buy, and they still can't beat the market consistently. So what exactly makes you think you can do it from your couch during your lunch break? Look, it's not an insult, it's math. Trying to beat the market by picking individual stocks is like trying to outsprint Usain Bolt after watching one YouTube video about running form. Inspiring? Yes. Statistically likely? Absolutely not. So here's where it gets interesting, because the market being hard to beat isn't even the real problem. The real problem is three things that are quietly destroying retail investor returns every single year, and nobody talks about them because fixing them would cost Wall Street billions of dollars. Problem 1, fees. The average actively managed mutual fund charges about 1% annually in fees. Sounds small, right? Let's do the math. $50,000 invested over 30 years at 10% returns with zero fees, $872,000. Same investment with 1% annual fee, $648,000. That 1% fee just cost you $224,000. That's a house. Wall Street charged you a house and called it a service fee. Problem 2, timing. The average retail investor dramatically underperforms the market they're invested in. How is that even possible? Because people panic sell at the bottom and buy back in at the top every single time. In 2020, when COVID crashed the market 34% in 33 days, millions of retail investors sold everything. The market recovered 100% in 5 months. The people who panicked missed the entire recovery. Emotional investing isn't investing. It's expensive gambling with extra steps. Problem 3, information asymmetry. When a company reports earnings, institutional investors already know what's coming, not illegally, through better research, better models, and better access. By the time the news hits your phone, the trade is already done. You're not getting in early. You're providing the exit liquidity for someone who got in 3 months ago. Let's just look at the raw numbers because they tell the whole story. Average retail investor annual return, 3 to 4%. Average S&P 500 annual return, 10%. Difference, 6% per year. On a $100,000 portfolio over 30 years, that 6% gap means the difference between $432,000 and $1.74 million. $1.3 million left on the table because of panic selling, bad timing, and fees. Not because the market failed you, because the behavior failed the market. And the financial industry profits every time you make that mistake, because your panic sell is someone else's discount buy. So what do you actually do with all of this? Because here's the thing, I'm not telling you the market is a scam. I'm telling you most people are playing it wrong, and the fix is almost insultingly simple. Option 1, index funds, full stop. Buy the whole market, every month, automatically. Don't touch it. This alone puts you ahead of 92% of professional fund managers. The boring option is statistically the best option. Option 2, kill the fees. Vanguard, Fidelity, and Schwab all offer index funds with fees below 0.05%. That's $5 per year on $10,000 invested versus $1,000 per year at 1%. The difference over 30 years is a down payment on a house. Option 3, automate everything. Remove emotion from the equation entirely. Set up automatic monthly contributions. Don't look at it during crashes. Don't celebrate during rallies. Just let compound interest do what it's been doing for 100 years. The market rewards patience and punishes emotion. Always has, always will. If you learned something today that your financial advisor forgot to mention, subscribe, because every week I cover the stuff that actually matters. No noise, no agenda, no $499 stock picking course, just the boring math that somehow changes everything. Drop in the comments, are you an index fund investor or a stock picker? And be honest, I'll reply to every comment in the first hour. See you next week.